Okay, let's unpack this. Picture a company that holds the keys to some of the world's most valuable oil fields. A true energy powerhouse.
Yeah.
But here's the twist. Its very destiny is caught in the constant push and pull of national politics. It's a high-stakes drama that's both compelling and incredibly complex.
Mm-hmm.
Today, we're pulling back the curtain on Petróleo Brasileiro S.A., or Petrobras, Brazil's integrated energy giant.
That's right.
Our mission today is to cut through that complexity, not just to inform you, but to arm you with a truly nuanced understanding of what makes Petrobras such a captivating yet incredibly challenging investment story.
Definitely.
We've compiled a stack of comprehensive investment analyses, the company's own reports, and some deep industry insights to guide our exploration.
And what's truly fascinating here, and really the core of our discussion, is precisely that duality you mentioned.
Right.
On one side, Petrobras boasts an almost unparalleled asset base and operational excellence, especially in the, demanding deepwater pre-salt fields. It's a technical marvel, really.
Yeah, it is.
Yet on the other, it grapples with inherent, often unpredictable risks that stem directly from its government control. This deep dive isn't just about what this company does, but why these two powerful forces are in constant tension, and critically, why that dynamic interplay matters so profoundly for anyone assessing its profile, whether you're an investor, a policymaker, or maybe just a curious observer.
That tension is palpable, yeah. And it's a perfect place to start. Let's maybe establish who Petrobras is at its core. It's far more than just an oil company. It's really a cornerstone of the entire Brazilian economy, foundational to the nation's energy independence and industrial growth.
Absolutely. Founded all the way back in 1953, right?
Yeah, 1953.
It quickly became a critical player, not just within Brazil, but on the global energy stage, evolving into a true national champion. And that foundational role means its influence just permeates across the nation. Petrobras is structured as an integrated energy company, meaning it covers almost the entire energy value chain. Understanding this comprehensive business model is absolutely key to grasping its immense scale and strategic importance.
You're spot on.
Yeah.
And when we map out its business model, it's really organized into three colossal main segments. The first, and arguably the most crucial given its profitability and strategic focus, is exploration and production, or E&P.
The core business.
Exactly. This is their core business, the primary value driver for the entire enterprise. It focuses on finding, developing, and producing crude oil, natural gas liquids, or NGLs, which are, hydrocarbons that become liquid at surface conditions, and natural gas.
Right.
And here's the kicker. Its strength comes from its unparalleled expertise and asset base in Brazil's incredibly challenging, yet immensely productive offshore pre-salt basins.
And that expertise in pre-salt isn't just an advantage, it's a defining competitive moat, really.
Definitely.
Complementing that, you have the refining, transportation, and marketing, or RTM segment. This encompasses their extensive downstream operations, everything from refining crude oil into various petroleum products like gasoline and diesel, to managing complex logistics through a vast network of pipelines and terminals, engaging in energy trading, and also includes their significant petrochemical operations, primarily through their substantial equity interest in Braskem.
Right, Braskem.
This segment essentially ensures the products from E&P reach the market.
And rounding that out, especially with an eye toward the future, is the Gas and Low-Carbon Energies division. This isn't just about natural gas. It's kind of where Petrobras is attempting to chart its future.
The transition piece.
Exactly. They handle the processing, transportation, and commercialization of natural gas and liquefied natural gas, or LNG. But beyond that, it branches out into electricity generation through thermoelectric plants and, crucially, houses the company's strategic initiatives in renewable energy and other low-carbon businesses. So for a company so deeply rooted in fossil fuels, this is where we see the most explicit attempts at diversification and maybe a forward-looking aspect, though it presents its own unique set of challenges, I imagine.
Oh, absolutely. And the sheer scale of Petrobras is often underappreciated, I think. It's worth drilling on for just a moment.
Yeah, let's do that.
As of early 2024, it employed over 41,700 people. I mean, that's a truly massive workforce for any company, let alone one operating in such a specialized sector.
Wow.
Its daily production capacity is around 2.78 million barrels of oil equivalent per day, making it one of the world's largest oil producers.
Huge.
And to fuel that production for the long term, its proved reserves stand at approximately 11.4 billion barrels of oil equivalent. Financially, for fiscal year 2023, the company generated a staggering US $102.4 billion in revenue.
100 billion.
Yeah, this isn't just a big player, it's a global energy titan by every conceivable metric.
That's an astonishing scale.
Yeah.
But here's the defining characteristic, right?
Yeah.
What truly sets it apart and introduces that constant tension you mentioned. Its status as a government-controlled private company.
Exactly.
The Brazilian federal government is the controlling shareholder, directly and indirectly holding 50.26% of the common or voting shares and about 28.67% of the total share capital as of February 2024.
Mm-hmm.
This structure grants the government decisive influence over the company's board of directors and therefore its strategic direction. Even though its shares are publicly traded on Brazil's B3 stock exchange and the New York Stock Exchange, that government control is always the ultimate arbiter, kind of a constant shadow influencing every major decision.
And this government-controlled private company status is indeed the critical lens through which to view everything else we discussed today. It fundamentally changes the motivations and decision-making processes compared to a purely private entity. Well, decisions aren't solely driven by maximizing shareholder value, which is, the norm for many publicly traded companies. They are often balanced and at times overridden by national policy objectives.
Wow.
This creates an inherent, almost existential tension that is crucial for understanding its investment profile.
Given this unique structure, this constant tension between private enterprise and national policy, how does Petrobras actually plan for the future? What's its long-term vision, its strategic plan 2050, and how does it try to navigate those dual currents?
That's an excellent question because it really highlights the company's complex balancing act. Petrobras's long-term vision, articulated in its Strategic Plan 2050, aims for the company to be the best diversified and integrated energy company in generating value.
That sounds ambitious.
It is. It's a significant ambition, trying to reconcile its ongoing and highly profitable focus on traditional oil and gas with a crucial diversification into low-carbon businesses.
Like what?
This includes areas like advanced petrochemicals, fertilizers, and biofuels. The challenge, of course, is how to pivot towards a lower carbon future while simultaneously leveraging its unparalleled strengths in hydrocarbon production, a tension that really defines its long-term trajectory.
And that ambitious long-term vision gets translated into actionable steps through their more immediate business plan for 2025-2029. What are the key strategic drivers outlined in that nearer-term plan?
Well, this near-term plan specifies key strategic drivers that reflect both commercial objectives and national policy. It includes a continued and highly profitable focus on its E&P assets.
Naturally.
A significant modernization of its refining park to increase efficiency and adapt to market needs, and a determined pursuit of what they term a fair energy transition.
Fair energy transition. What does that actually mean in practice?
That's a really interesting point. It seems to imply a transition that considers Brazil's specific economic and social realities rather than just, blindly mirroring global timelines or mandates.
Okay, makes sense. Now, here's where it gets really interesting for anyone looking at this company's future trajectory. A central element of this latest plan is a substantial increase in capital expenditure, or CapEx.
Right, a big jump.
Yeah, the 2025-2029 plan forecasts total investments of U.S. $111 billion. This is comprised of U.S. $98 billion for projects already under implementation, plus an additional U.S. $13 billion for projects still under evaluation.
That's a huge number.
It's a truly significant ramp-up from the U.S. $102 billion outlined in the previous 2024-2028 plan. And the allocation of this capital tells a very specific story. E&P remains the primary destination, with U.S. $77.3 billion allocated, and about 60% of that going to high-value pre-salt assets.
A cash cow.
Exactly. But the downstream sector, including RTM, petrochemicals, and fertilizers, is said to receive U.S. $19.6 billion, which is a substantial 17% increase compared to the prior plan. What does this pronounced shift in capital allocation signify, particularly this boost for the downstream sector? What are the implications for its overall strategy?
Yeah, that increased downstream allocation is a clear departure from previous strategies that often prioritize debt reduction and a laser focus on pure E&P concentration.
Right.
It directly reflects the controlling shareholders' policy objectives, enhancing Brazil's domestic energy security by reducing reliance on imported fuels and leveraging Petrobras for broader industrial development. Think jobs, local content, value-added products.
Okay, so nation building almost.
In a way, yeah. The insight here for investors is that while this diversifies revenue and builds national capacity, it often comes at the expense of pure profit maximization.
Wow.
We're looking at a scenario where a dollar invested downstream might yield a lower return on invested capital than if it were pumped into another incredibly profitable pre-salt well, but it fulfills a critical government mandate.
So it's a trade-off.
It's a direct, measurable trade-off for minority shareholder value that we need to explicitly acknowledge and factor into our assessment. It really underscores that dual current we spoke about earlier.
Makes sense.
Yeah.
Okay, no company, especially one as globally integrated and nationally significant as Petrobras, operates in a vacuum. Let's shift our focus a bit and look at the broader environment it navigates, starting with the global oil and gas outlook for 2024-2026. This external landscape can either create tailwinds or, well, significant headwinds for a company of this scale.
Indeed, and the overall outlook for this period, according to various industry analyses, appears to be one of ample supply and moderating demand growth.
Okay.
This combination, if it holds true, has the potential to put sustained downward pressure on prices, creating a challenging operating environment for all energy companies, including Petrobras, despite its operational strengths.
Right. When we talk about supply dynamics, global oil supply is actually forecast to continue expanding, with the majority of growth coming from non-OPEC plus producers.
Like the U.S.
Yeah, countries like the United States, with its resilient shale output, as well as Brazil itself and Guyana, are expected to be the primary drivers of this new production. And at the same time, the OPEC Plus alliance is gradually unwinding its voluntary production cuts, which means more barrels are slated to enter the market.
So more supply coming online.
Exactly. All these factors collectively contribute to a well-supplied outlook, creating a more competitive environment.
And on the demand side, forecasts for global oil demand growth in 2025 have already seen some downward revisions by key agencies.
Really?
Yeah. For instance, the International Energy Agency, or IEA, projects an increase of approximately 700,000 barrels per day. But importantly, this growth is largely concentrated in non-OECD economies, particularly in developing Asia.
Okay.
Recent data has also indicated a somewhat lackluster demand in major established economies, including China and even right there in Brazil, suggesting that a sharp or broad rebound in overall global demand is unlikely to be the primary driver of prices in the immediate future.
And this combination of ample supply and moderating demand has led to a distinctly bearish price outlook from some key agencies. For example, the U.S. Energy Information Administration, or EIA, projects that global oil inventory builds will accelerate.
Building inventories, yeah.
This could cause Brent crude oil prices to decline from around U.S. $71 per barrel in mid-2025 to an average of U.S. $58 per barrel in the fourth quarter of 2025, and potentially even near U.S. $50 per barrel in early 2026. Those are significant drops.
Very significant. And this bearish price outlook, if it materializes, creates a very significant headwind for every player in the energy sector.
Right.
For a company like Petrobras, despite its remarkably low production costs, lower market prices directly impact its top-line revenue and significantly squeeze its cash flow generation. This makes strategic choices and capital allocation decisions, especially those balancing commercial returns with national policy, even more critical and potentially more difficult to justify if the financial buffers shrink.
Yeah, that makes sense. Beyond these global market forces, the Brazilian regulatory framework is another defining feature of Petrobras's operating environment, shaping everything from exploration rights to the very structure of the energy market. This isn't just about rules, it's about the very playing field, isn't it?
Absolutely. Brazil's oil and gas sector is primarily overseen by two key federal entities, each with distinct but complementary roles. First, you have the National Energy Policy Council, or CNPE.
Okay, CNPE.
This is the high-level body responsible for setting national energy policy and authorizing bidding rounds for exploration blocks. Think of them as the strategic planners.
Got it.
Then there's the National Agency of Petroleum, Natural Gas, and Biofuels, or ANP, which acts as the sector's independent regulator. The ANP implements those policies, sets technical rules, conducts the actual auctions, and supervises all industry activities. They are the enforcers and the day-to-day administrators.
Okay, CNPE sets policy, ANP regulates. And for exploration and production, Brazil actually employs a mixed framework for awarding rights, which reflects the varying geology and strategic importance of its basins. There's the concession regime, which is the traditional model applied in most areas.
Right.
Here, the winning bidder takes on all exploration risk and, if successful, gains ownership of any hydrocarbons produced, subject to royalties and taxes. It's a classic ownership model.
Pretty standard. Then there's the Production Sharing Agreement, or PSA, which is mandated specifically for the pre-salt polygon and other designated strategic areas.
Why the difference there?
Well, under this regime, the government retains ultimate ownership of the oil and gas in the ground. Companies bear the exploration risk and, in the event of a commercial discovery, are reimbursed for their upfront exploration and development costs. This is what we call cost oil.
Okay, cost oil.
After that, they receive a negotiated share of the remaining production, which is the profit oil. The key here is that, unlike in a traditional concession, the government, as the ultimate resource owner, has a much more direct and active stake in the economic outcome from day one, essentially getting its share of the profits directly in oil.
Ah, okay.
This is chosen for the pre-salt because these are strategically vital, highly productive assets, and the government wants to retain maximum control and upside potential.
Makes sense for the crown jewels. And finally, there's the transfer of rights, or to-heir regime. This was a very specific one-off arrangement created to grant Petrobras the right to explore and produce up to 5 billion barrels of oil equivalent in certain ungranted pre-salt areas in exchange for a substantial payment to the government.
A unique deal.
Yeah, it's an example of how the government can directly intervene to manage its resources and, in this case, shore up Petrobras' access to key assets. But beyond these, the biggest, most impactful regulatory shakeup currently unfolding is something called the Novo Mercado do Gás, the new gas market. So what does this monumental shift mean for Petrobras, which has historically dominated Brazil's natural gas sector?
Ah, the new gas law.
Yeah.
Yes, law number 14.1342021 represents perhaps the most significant regulatory transformation in Brazil's energy sector in decades, specifically targeting natural gas.
Okay.
Its primary objective is ambitious: to dismantle Petrobras's historical de facto monopoly in the natural gas midstream sector and foster a truly competitive, open, and liquid market. This is a game changer designed to attract private investment and lower gas costs for consumers and industry.
That sounds like a monumental task, dismantling a historical monopoly like that. What were the most significant levers the government pulled to achieve this, and which of those pillars has had the most immediate impact?
Well, there are several key pillars to this reform, all designed to pry open the market. First, and perhaps most structurally important, is unbundling.
Unbundling.
Yeah. This enforces the structural separation of gas transportation and distribution from other parts of the value chain, like production and commercialization. This prevents vertically integrated players, historically Petrobras, from using their control over infrastructure to block or disadvantage competitors.
Okay, stops them using their pipes to block others.
Exactly. Second, third-party access. The law mandates non-discriminatory access for all market participants to essential infrastructure, including gas processing plants, transport pipelines, and LNG regasification terminals.
And Petrobras owns a lot of that.
A significant portion of this critical infrastructure is currently owned by Petrobras, so this pillar forces them to open up their networks. And third, the authorization regime. The process for building new transport pipelines was simplified from a complex, time-consuming concession model to a more streamlined authorization model, which is intended to accelerate infrastructure investment and bring new players into the market much faster.
So this is clearly a direct challenge to Petrobras's long-standing dominance in natural gas midstream.
It absolutely is, and it presents a strategic inflection point for Petrobras. By forcing the company to open its extensive midstream infrastructure to competitors, the law directly challenges a long-held source of competitive advantage and market control, particularly for its natural gas processing and transportation.
But is there an upside for them?
Actually, yes. This reform also carries a significant, albeit less obvious, benefit for Petrobras as an upstream producer. Well, a more dynamic and competitive domestic gas market with more buyers and potentially lower end user prices is expected to stimulate industrial demand significantly. This, in turn, creates a larger and more liquid market for Petrobras to monetize its own vast natural gas reserves from the pre-salt reserve that might otherwise be stranded or difficult to bring to market.
So bigger market for the gas.
Precisely. So while it loses its midstream monopoly, it could gain substantial value by shifting its focus and expertise towards upstream efficiency and becoming a dominant supplier in a much larger, more robust domestic gas market.
Interesting dynamic. Okay, now let's talk about where Petrobras truly shines, the operational heart of its profitability. its upstream engine, the pre-salt. This is where the company truly demonstrates its world-class capabilities, right?
Without a doubt, the exploration and production segment is overwhelmingly dominated by activities in the pre-salt layer of the Santos and Campos basins. This isn't just a geological curiosity, it's where you find truly world-class assets and witness their cutting-edge capabilities.
And the numbers are just staggering, putting Petrobras in an elite league. Pre-salt fields are the company's primary source of production, accounting for a remarkable 81% of its total output in 2024.
81%.
Yeah, this heavy concentration reflects the superior geology and the incredible productivity of these assets. The cornerstone fields Tupi, Buzios, and Mero, all located in the Santos Basin, are not just big, they are among the largest and most productive deepwater fields globally.
Truly massive fields.
What's also fascinating about these cornerstone fields isn't just their individual scale, but the sophisticated dance of partnerships. For instance, in Mero, Petrobras holds a significant 38.6% stake, but global majors like Shell and Total Energies each have almost 20%, with other partners like CNOC, CNODC, and PBR-A also involved.
Spreading the risk and capital.
Exactly.
Yeah.
This multi-company effort isn't just about sharing capital. It often means distributing political risk and leveraging diverse expertise. Then you have fields like Buzios, where Petrobras's dominant 88.99% stake means it retains almost full operational control, and therefore also takes on a much larger share of any political or economic upside or downside.
Right. More control, more exposure.
So these seemingly dry percentages tell a dynamic story about distributed risk and concentrated control, highlighting the global interest in these unique assets.
And this consistent growth and increasing dominance of pre-salt production is underpinned by a systematic and continuous deployment of new floating production, storage, and offloading, or FPSO units.
These huge ship-like facilities.
Exactly. These massive floating factories are crucial for deep-water operations like the pre-salt because they handle everything from extraction and initial processing to storing oil and gas right at the wellhead, eliminating the need for extensive subsea pipelines over vast distances.
Makes sense.
The company's 2025-2029 business plan calls for the implementation of 10 new production systems, 9 of which are already contracted, ensuring a clear growth trajectory for the medium term.
So more FPSOs coming online.
Yep. You can see this impact already with new FPSOs like the Almirante Tamandaré in the Buzios field and the Marechal Duque de Caxias in the Mero field ramping up in 2024-2025, significantly contributing to their production figures and solidifying their future output.
The scale and productivity of these pre-salt assets are clearly world-class. But as you said, it's not just about geology, it's about how Petrobras operates them. This is where their competitive advantages become incredibly evident.
Exactly. Petrobras possesses 2 powerful and deeply interconnected competitive advantages in its pre-salt operations. Exceptionally low production costs.
The famous low costs.
Which are a direct result of their profound technological leadership. These aren't just nice-to-haves, they are fundamental differentiators.
I'm looking at these figures for their pre-salt lifting costs, and they're showing something truly remarkable. As low as approximately US $5 per barrel for deep water. US $5 a barrel. That number, honestly, almost defies belief given the complexity of the environment.
It's astounding, isn't it?
What is it, specifically, that allows Petrobras to achieve such incredibly low costs in such a challenging environment? It feels like there's a unique secret sauce here that we need to uncover.
Well, that low-cost structure, which is genuinely among the lowest in the world for deepwater production, provides extraordinary resilience. It allows the company to remain highly profitable even in periods of depressed global oil prices, acting as a crucial buffer.
Right.
For comparison, leading U.S. shale producers, often cited for their efficiency, like ExxonMobil, target production costs of around US $15 per barrel in the prolific Permian Basin.
15 versus 5. Big difference.
Huge difference. Even Petrobras's own partners in the pre-salt, like Total Energies, acknowledge their costs are well below US $20 per barrel of oil equivalent. This massive cost advantage is primarily due to their proprietary technological moat.
Their tech.
Exactly. Over decades, Petrobras has developed a suite of specialized technologies specifically designed to overcome the immense and unique challenges of the pre-salt environment, which includes water depths exceeding 2,000 meters, navigating through a thick and mobile salt layer, and dealing with reservoirs that have high gas and CO2 content. These aren't just minor tweaks. These are fundamental engineering breakthroughs.
So their technology isn't just a nice-to-have. It's absolutely essential to making these fields not just viable, but incredibly profitable.
Precisely. Take their carbon capture, usage, and storage, or CCUS, for enhanced oil recovery, EOR. Petrobras operates what is, to our knowledge, the world's largest deep-water CCUS program. Instead of simply venting the naturally occurring CO2 that comes up with the oil from these reservoirs, the company separates it on the FPSOs, compresses it, and then re-injects it back into the fields.
Okay.
This serves a brilliant dual purpose. It dramatically reduces the carbon intensity of its production operations, a key environmental benefit, and it acts as an enhanced oil recovery mechanism by increasing reservoir pressure and boosting the ultimate recovery of oil from these immense fields.
So less CO2 and more oil.
Exactly. By 2022, the company had already re-injected over 40 million tons of CO2, a testament to its scale and effectiveness.
That's a truly ingenious innovation, solving an environmental challenge while simultaneously improving oil recovery and profitability. It's a real win-win.
It is, and it doesn't stop there. They also developed HISEP, which stands for high pressure separation.
What HISEP?
Yeah, HISEP. This is another groundbreaking and patented subsea technology that literally separates CO2-rich gas from the oil directly on the seabed, miles below the surface.
On the seabed, how does that work?
Well, this gas is then immediately re-injected into the reservoir without ever being brought up to the surface platform.
Ah, okay.
This innovation significantly reduces the volume of gas that needs to be processed on the FPSO, allowing for smaller, lighter, and less expensive topside facilities. It also further lowers the carbon footprint of production by minimizing processing on the surface.
A rubber.
It's thinking entirely outside the box, or rather, outside the FPSO.
That truly is innovative. And what about exploration and drilling itself? How do they maintain an edge in finding and accessing these challenging reservoirs?
Well, for exploration and drilling, Petrobras leverages a powerful array of supercomputers and advanced artificial intelligence algorithms to process incredibly complex seismic data.
Using AI.
Yeah. This improves the imaging and understanding of the subsalt reservoirs, allowing them to pinpoint the most promising drilling locations with greater accuracy. This, combined with their remote drilling operations centers, enhances drilling success rates, optimizes well placement, and crucially, reduces both the costs and time involved in bringing new wells online.
So it's faster and cheaper too.
Exactly. This technological leadership is a powerful differentiator that wasn't just developed out of ambition, but out of necessity, really. These solutions don't just make production possible, they make it more profitable, safer, and less carbon-intensive, creating a self-reinforcing advantage that's very difficult for competitors to replicate. It's their secret weapon in the deep.
Moving from the incredible engineering feats of the pre-salt, let's look at their downstream operations: refining, marketing, and petrochemicals. While E&P is undoubtedly the primary profit center, this segment provides crucial strategic integration, scale, and a dominant position in the vast Brazilian domestic market, offering a different kind of stability.
That's right.
Petrobras's refining park is actually the largest in all of Latin America. In 2024, the company's domestic production of oil derivatives reached 2.2 million barrels per day, utilizing an impressive 86.4% of Brazil's total installed refining capacity.
Huge domestic footprint.
Yeah, this gives them a market share of over 80% in domestic fuels, conferring significant pricing power and logistical control within Brazil's expansive borders.
And they've shown truly impressive operational excellence in this area as well, achieving a total refinery utilization factor, or FUT, of 93% in 2024.
93% is high.
It is. This is their highest FUT since 2014, signaling not only robust operational efficiency, but also strong demand in the domestic market, directly impacting their profitability. This high efficiency enabled record production of key high-value products, including 420,000 barrels per day of gasoline and 452,000 barrels per day of S10 or low-sulfur diesel in 2024. A key strategic shift that further enhances their efficiency has been their increased use of their own light, sweet, pre-salt crude as feedstock, which reached 70% of the total processed volume in 2024.
Using their own best crude.
Exactly. This integration optimizes the product slate towards more valuable derivatives like gasoline and diesel, and also helps reduce emissions by processing lighter, cleaner crude.
And in petrochemicals, Petrobras maintains a strategic foothold through its 36.1% equity stake in Braskem, which happens to be the largest producer of thermoplastic resins in the Americas.
Right, Braskem again.
However, the broader Brazilian chemical industry faces significant headwinds, right? Including high feedstock costs and intense competition from lower-cost imports. This has led to high levels of idle capacity across the sector, reaching 38% in the first quarter of 2025. It seems like a challenging environment for this part of the business.
It is indeed a challenging sector globally, and Brazil is no exception. However, despite these headwinds, Petrobras's latest strategic plan signals a renewed commitment to the sector.
Oh, really? How so?
Well, this includes concrete plans to resume construction of the Gaslub petrochemical complex, which is particularly significant because it will notably utilize natural gas from the pre-salt as its primary feedstock.
Connecting upstream gas to downstream chemicals.
Precisely. This shows a long-term vision for vertical integration, attempting to create value from their vast natural gas reserves by transforming them into higher-value petrochemical products domestically, rather than simply exporting the raw gas. It's a strategic play to add value within Brazil, aligning with those national policy objectives we discussed earlier, even if the short-term economics are tough.
Right, that policy angle again. Okay, so how do these massive operations, from the deep-sea marvels of pre-salt to the vast refining complex, actually translate into financial performance? Let's dive into the numbers and understand how Petrobras manages its capital. We've been looking at data from 2022 to 2024, and what's immediately clear is a strong correlation between Petrobras' financial results and global energy prices.
Oh, absolutely. That correlation is undeniable. Revenues and profitability peaked in 2022, which was, a year characterized by exceptionally high Brent crude prices following global supply disruption.
After the invasion of Ukraine.
Exactly. They then predictably moderated in 2023 and 2024 as commodity prices normalized. To give you some specifics, sales revenue, for example, went from a robust U.S. $123.1 billion in 2022 to U.S. $102.4 billion in 2023, and then down to U.S. $89.4 billion in 2024.
Still huge numbers, but a clear drop.
Yeah. Similarly, adjusted EBITDA, a key measure of operational profitability, saw a decline from U.S. $66.2 billion in 2022 to U.S. $52.4 billion in 2023, reaching U.S. $40.4 billion in 2024. Net income followed a similar downward trajectory, from a stellar U.S. $36.6 billion in 2022 down to U.S. $7.5 billion in 2024. Despite these revenue and net income declines, which are quite significant year over year, it's impressive to see their operating cash flow remaining remarkably robust. It went from U.S. $49.7 billion in 2022 to U.S. $43.2 billion in 2023 and U.S. $39.9 billion in 2024.
Still generating a lot of cash. Yeah, that consistency in the face of falling commodity prices is truly telling. Crucially, this strong operating cash flow consistently and comfortably covered their increasing capex, which grew from U.S. $9.6 billion in 2022 to U.S. $16.6 billion in 2024.
Ramping up investment.
Right. This resulted in healthy free cash flow, from U.S. $40.1 billion in 2022 down to U.S. $23.3 billion in 2024. What does that kind of consistent cash flow generation tell us about the company's underlying financial health?
Well, this consistent, robust operating cash flow generation is a direct consequence of those incredibly low pre-salt production costs we discussed earlier. It's their ultimate financial buffer.
The cost advantage pays off.
Absolutely. It provides significant financial strength and flexibility, allowing them to weather price fluctuations much better than many peers who have higher cost bases. In terms of the balance sheet, gross debt increased from U.S. $53.3 billion in 2022 to U.S. $60.3 billion in 2024, and net debt rose from U.S. $37.6 billion to U.S. $52.2 billion over the same period.
So debt is going up.
It is. While we see gross debt creeping up, what's crucial for the informed investor is the leverage ratio. It went from a very conservative 0.57 times net debt to adjusted EBITDA in 2022 to a still manageable 1.29 times by 2024.
Is 1.29x high?
Well, this increase is notable, but it's important to frame it. 1.29x is still considered moderate for an energy major, especially one with such consistent cash flows and a strong asset base. It suggests they have ample room to fund their ambitious capex plans without undue stress, a critical buffer when facing potential political pressures or market downturns.
Okay, moderate leverage.
And crucially, their total production consistently grew from 2.689 million barrels of oil equivalent per day in 2022 to 2.782 million BOE in 2024, demonstrating that operational growth is continuing despite the price volatility.
So their operational strength is clearly translating into healthy cash flows and a manageable debt profile. Let's look at how they allocate that capital and, vitally, how they remunerate shareholders. Petrobras's capital allocation framework, detailed in its business plan, aims to strike a delicate balance. reinvestment for growth, returns to shareholders, all while maintaining a strong balance sheet.
Right. Their financial strategy prioritizes a flexible and efficient capital structure, with a key tenet being the generation of cash flow in excess of investments and financial obligations, ensuring self-funded growth.
Okay.
The 2025-2029 business plan establishes a gross debt limit of US $75 billion. This ceiling isn't arbitrary. It provides ample flexibility for the planned increase in CapEx while signaling a commitment to ensuring leverage remains manageable, even in lower oil price scenarios.
A debt ceiling.
Yeah. And all investment projects are subject to a rigorous approval process, requiring a positive net present value, NPV, meaning the present value of expected cash inflows exceeds the present value of expected cash outflows, even under a conservative bear case scenario. This is designed to ensure financial discipline, at least on paper.
Now, this is a really important detail, a formula-driven dividend policy in a state-controlled company. Their shareholder remuneration policy is transparent and aims to provide predictability to its shareholders, which is, well, a rare and valued quality in this space.
Very rare.
The policy stipulates that if the company's gross debt is at or below the US $75 billion threshold, it will distribute a significant 45% of its free cash flow.
45%, that's substantial.
Yeah. For example, they distributed US $19.0 billion for fiscal year 2023 and have proposed US $13.5 billion for 2024, with payments regularly scheduled, like the one for August 20, 2025, for remuneration related to the first quarter of 2025. Why is this formulaic, rule-bound dividend policy so significant for investors, especially minority shareholders who don't have government backing?
That's a crucial point. In an entity where cash flow could potentially be diverted to politically motivated projects with questionable financial returns.
Which is always the fear.
Exactly. Linking shareholder returns to a transparent, auditable metric like free cash flow creates a visible and enforceable trade-off. To reduce dividends below the stated policy, the government, as the controlling shareholder, either has to accept lower operational cash flow, for example, by imposing price controls that directly harm margins, or approve significantly higher CapEx that eats into that free cash flow.
So it makes the cost of meddling obvious.
Precisely. This acts as a crucial guardrail, enhancing financial discipline and offering a tangible degree of protection against arbitrary capital retention or political meddling for minority shareholders. It essentially puts a clear cost on government intervention that deviates from shareholder value maximization.
That makes perfect sense. It offers a degree of certainty in an otherwise uncertain environment. Let's turn our attention now to management quality and the governance structure. These are paramount considerations for any investment, but they take on heightened importance in the unique context of a state-controlled enterprise like Petrobras.
Absolutely critical here. Petrobras's senior leadership is appointed by its board of directors, which is in turn heavily influenced by the controlling shareholder, the Brazilian federal government.
Right.
The executive team is led by a president, who is also the CEO, and 8 executive officers elected by the board for 2-year terms. The current CEO, Magda Chambriard, appointed in May 2024, has a strong technical background with a master's degree in chemical engineering and a long career at Petrobras, followed by a tenure as head of the regulatory agency, ANP.
So she knows the industry and the regulation.
Definitely. However, a notable characteristic of the current leadership is its relative newness. The average tenure of the management team is approximately 1.2 years.
Wow, just over a year on average.
Yeah. This frequent, politically driven turnover in leadership is a clear illustration of that tension between commercial objectives and national policy, often leading to strategic instability. It's a revolving door sometimes.
That rapid turnover certainly points to a direct political influence on the company's direction. What about the board itself, which is supposed to provide oversight?
Well, the board is composed of a minimum of 7 and a maximum of 11 members. The company's bylaws grant the federal government the right to appoint the majority of these members, ensuring its strategic control.
Government appoints the majority.
Yes. To ensure a degree of independence and representation, the bylaws also mandate that the roles of chairman of the board and CEO must be separate. Critically, there are also guaranteed board seats for representatives of minority shareholders and employees, theoretically providing additional checks and balances and diverse perspectives in decision-making.
Okay, some minority representation. And crucially, Petrobras undertook a comprehensive overhaul of its governance and compliance systems in the aftermath of the infamous Operação Lava Jato, or Operation Car Wash, corruption scandal.
A huge turning point.
Yeah, this wasn't just a corporate cleanup. It was a national reckoning that shook Brazil's political and economic foundations. The sheer scale of the fraud, involving billions in kickbacks and widespread political corruption, had an almost existential impact on Petrobras, threatening its very ability to operate and borrow internationally. Regaining market credibility, both domestically and internationally, became an absolute imperative. So what specific fundamental changes did they implement, and perhaps more importantly, how confident can investors truly be that these new mechanisms are robust enough to withstand future political pressures, given the company's inherent state control?
You've hit on a pivotal moment in the company's history. As a publicly traded company on multiple exchanges, Petrobras adheres to the rules of the Brazilian Securities and Exchange Commission, or CVM, the U.S. Securities and Exchange Commission, or SEC, and is listed on B3's Level 2 corporate governance segment in Brazil, all of which mandate high standards.
Right.
In response to Lava Jato, they implemented a robust, three-pillared compliance program focused explicitly on the prevention, detection, and remediation of misconduct, including fraud and corruption. This program is meticulously designed to align with stringent international anti-corruption laws, such as the U.S. Foreign Corrupt Practices Act, or FCPA, and the U.K. Bribery Act.
So, serious compliance efforts. And the oversight structure sounds incredibly comprehensive on paper, especially post-Lava Jato. But despite all these robust mechanisms, how much comfort can investors really take when the ultimate power to change leadership and strategic direction still resides with the government? Is it a true firewall or more of a, speed bump?
That's the fundamental dilemma, isn't it? The oversight structure is indeed multi-layered, comprising the General Shareholders Meeting, a fiscal council, the board of directors, and an executive board. These bodies are supported by a network of advisory committees, including a statutory audit committee, a people committee, and a governance and compliance technical committee, all designed to provide specialized oversight and enhance transparency.
Lots of committees.
Yeah, significant efforts have also been made to cascade these best practices down to the company's numerous subsidiaries. However, while the governance structure on paper is robust and designed to function like an independent corporation, the practical reality is that the controlling shareholder retains the power to change key personnel and influence strategic direction, often overriding these formal mechanisms or subtly shaping their interpretation.
Wow.
This frequent politically driven leadership change is the clearest illustration of that inherent tension. It's a constant negotiation, not an absolute firewall.
That paints a clearer picture of the tightrope walk they're on. Now, let's see how Petrobras stacks up against its peers and truly understand the unique tightrope investors face. It occupies a distinct and often paradoxical position in the global energy landscape, blending the characteristics of a state-backed national oil company, or NOC, with the operational capabilities of a top-tier international oil company, or IOC.
Exactly. This creates what we call a hybrid NOC-IOC profile, which is both its greatest strength and its most significant vulnerability.
How so?
Well, as an NOC, Petrobras benefits from privileged, almost sovereign access to Brazil's vast hydrocarbon resources, particularly the world-class pre-salt province. This sovereign backing provides a foundational competitive advantage that most IOCs lack, as they must compete globally for access to high-quality reserves.
Right, they own the keys to the kingdom, essentially.
Pretty much. This has allowed Petrobras to build immense scale, becoming one of the world's largest oil producers with an integrated network of infrastructure that dominates the domestic market. It's essentially got guaranteed access to a national treasure.
But unlike many NOCs that can be plagued by operational inefficiency, high cost, or a lack of innovation, Petrobras has developed elite technical expertise in deepwater E&P that is truly second to none.
World-class tech, as we discussed.
Right. This operational prowess allows it to execute complex projects with an efficiency and cost structure that rivals or even exceeds that of the most capable IOCs. That combination of sovereign resource control and elite operational capability in its core E&P segment is truly the company's defining strength, making it a unique beast in the energy world.
This is indeed the core tension. The primary disadvantage of its NOC status is the persistent and often unpredictable risk of government interference.
The other shoe.
Exactly. Strategic decisions, pricing policies for domestic fuels, and management appointments can be heavily influenced by political considerations that may diverge significantly from the goal of maximizing shareholder value. For instance, past governments have exerted pressure to keep domestic fuel prices artificially low to curb inflation, directly impacting Petrobras's refining margins.
Fuel subsidies.
Right. Similarly, investment decisions might be steered towards projects that generate local employment or develop specific regions, even if they offer lower financial returns than purely commercial alternatives. And while significant governance reforms have addressed past corruption scandals like Operation Lava Jato, that history still remains a consideration for investors, raising questions about future resilience to political pressures.
So the ghost of Lava Jato lingers.
It does. Investors must weigh the IOC-like efficiency of its pre-salt operations against the inherent and often opaque risks associated with its NOC structure. It's a constant balancing act between geology and governance.
To really put this into perspective and understand that balancing act, let's look at some peer benchmarking from fiscal year 2024. For instance, Petrobras had sales revenue of US $89.4 billion, with an adjusted EBITDA margin of 45.2% and a net margin of 8.4%. Its net debt to adjusted EBITDA was 1.29x, and it boasted a remarkably high dividend yield of 14.0%.
14% yield.
Yeah. When you compare its adjusted EBITDA margin of 45.2% to global peers like Equinor at 28.7% or Total Energies at 8.5%, Petrobras' superior margin really stands out. What does that tell us about its operational efficiency?
That superior margin is a direct and undeniable reflection of its incredibly low-cost pre-salt production base. It means that for every dollar of revenue, Petrobras retains significantly more operating profit compared to many of its peers thanks to that US $5 barrel lifting costs we discussed.
Right, cost advantage again.
Its leverage of 1.29 times net debt to adjusted EBITDA is moderate. It's comparable to Ecopetrol's 1.35x, but it is noticeably higher than European majors like Equinor at 0.32x or Total Energies at 0.18x, who have aggressively delevered in recent years.
So not as low leverage as the European majors.
No. This suggests that while Petrobras' debt is manageable, it's not as conservative as some, perhaps reflecting its ambitious capex plans. And what's particularly striking, as you mentioned, is its notably higher dividend yield of 14.0% versus most peers, such as Equinor at 6.5% or Total Energies at 5.1%.
Why such a high yield?
Well, this isn't necessarily a sign of greater financial generosity, but rather it strongly suggests the market demands a significantly higher return to compensate for the perceived political and country-specific risks inherent in investing in Petrobras.
The risk premium.
Exactly. It's the market's way of pricing in that government control and the associated uncertainties.
That's a very important distinction to make. Moving to operational metrics, Petrobras' total production in 2024 was 2.78 million barrels of oil equivalent per day, with liquids making up a dominant 79% of that output. It had proved reserves of 11.4 billion BO, giving it a reserve life of 11.2 years. How does this compare in terms of sheer scale and operational focus?
In terms of production scale, Petrobras is truly in the league of super majors, with its 2.78 million BOD output comparing favorably to, for example, Total Energies at 2.43 million BOD. Is also significantly larger than other Latin American peers like Ecopetrol at 0.75 million BOD or YPF at 0.55 million BOD.
So a giant in Latin America.
Absolutely. The heavy liquids weighting of 79% is a clear and direct reflection of its strategic focus and the prolific nature of its pre-salt assets, which primarily yield high-quality crude oil. This positions them as a major global player, particularly in deep-water oil production.
Okay, let's unpack this further then. Given all we've discussed, the incredible assets, the complex regulatory shifts, the pervasive political influence, and its financial performance, what are the absolute key investment merits and the equally critical risks for anyone looking at Petrobras?
Okay, the key investment merits are genuinely compelling and set Petrobras apart. First, its world-class upstream asset base. The unparalleled pre-salt fields are truly the envy of the industry giant reservoirs. Highly productive wells, high-quality light oil. These are assets that offer decades of low-cost production.
The crown jewels.
Definitely. Second, and a direct result of that, are its industry-leading low production costs. We've highlighted those around US $5 per barrel lifting costs in pre-salt. This is a substantial competitive advantage, ensuring high profitability and resilience even in depressed oil price periods, making it a robust player through market cycles.
Resilience is key.
Third, it generates robust and predictable cash flow. The combination of high production and those remarkably low costs results in powerful operating cash flow, allowing them to self-fund their ambitious capex plans and provide substantial formulaic shareholder returns via their transparent dividend policy.
The dividend policy we talked about.
Exactly. And fourth, it holds a dominant and integrated domestic position. Control over most of Brazil's refining capacity provides a captive market for its crude and a dominant position in the domestic fuel market, offering a crucial layer of earnings stability and national energy security.
Those are undoubtedly powerful advantages, painting a picture of an exceptionally strong operational entity. But there's always the other side of the coin, the equally significant and perhaps more unpredictable risks that investors must constantly weigh.
Absolutely. The key risks begin with commodity price volatility. As an integrated oil and gas producer, Petrobras's revenues, profitability, and cash flows are directly and materially exposed to the inherent volatility of global prices for crude oil, natural gas, and refined products. Even with low costs, extreme price drops hurt.
Standard industry risk.
Yes, but amplified here. But the most significant and complex risk, and one we've returned to throughout this deep dive, is political and regulatory risk.
The big one.
Yeah. As a state-controlled entity, Petrobras is perpetually subject to direct intervention from the Brazilian government. This can manifest as strategic misalignment, where the government directs investments or strategies for national policy goals like job creation or industrial development over optimal financial returns for minority shareholders.
Politics over profits.
Potentially. There's also constant pricing policy pressure, with historical instances of governments pushing for the company to subsidize domestic fuel prices to control inflation, which directly compresses refining margins and overall profitability. Even with a revised reference oil price framework, the risk of policy changes impacting project economics is ongoing.
That fuel price issue keeps coming up.
It does. And of course, management and board changes are often politically driven, leading to strategic instability and uncertainty in long-term planning. The revolving door.
And there are broader macroeconomic risks too, right? Especially with its exposure to Brazil's economy.
Yes. Currency exposure, BRL-USD, is a significant factor. The company reports its financial statements in US dollars, but a substantial portion of its operating expenses and taxes are denominated in Brazilian reais. Conversely, much of its debt is in US dollars.
So a weaker real hurts them.
A depreciation of the real against the dollar increases the real equivalent cost of servicing its dollar-denominated debt, which can negatively impact net income. Finally, we must consider operational and legal hazards. Ultra-deepwater drilling carries inherent significant risks like spills and accidents.
Deepwater horizon is always in the back of your mind.
Exactly. Notably, Petrobras does not maintain business interruption insurance for most of its Brazilian operations, meaning a significant incident could have a material adverse financial impact without that immediate buffer. Additionally, the company is subject to significant contingent liabilities from ongoing legal proceedings, such as a $36 billion lawsuit from Seek Brazil, which presents a non-trivial financial exposure.
So after traversing all these intricate layers of operations, finances, and politics, it all comes down to this core question. How do we truly reconcile Petrobras's undeniable operational strength and its world-class assets with the equally undeniable and often unpredictable political realities it faces?
Well, this raises an important question that every investor must confront, really. The investment thesis for Petrobras is built on an enduring tension. The exceptional, almost unmatched quality of its underlying assets versus the significant and often unpredictable risks associated with its sovereign ownership.
Assets versus politics.
Exactly. The primary value driver is its unparalleled portfolio of low-cost, high-productivity pre-salt assets, a deep structural advantage that most global energy companies can only dream of. Its ability to extract oil from these deepwater reservoirs at around US $5 per barrel is a world-class achievement, incredibly difficult for competitors to replicate, firmly placing Petrobras in the top tier of global E&P operators. That's the end.
But that doesn't tell the whole story, does it? That engine, no matter how powerful, is still steered by a hand that isn't always purely commercial. The risk side of the equation is equally powerful and shapes the perception of that underlying value.
Precisely. The realization of this intrinsic value for minority shareholders is by no means guaranteed. The central question for an investor is how to properly discount this operational excellence for the considerable political and macroeconomic risks inherent in its operating environment.
How much do you discount for the politics?
That's the multi-billion-dollar question. The Brazilian government has repeatedly shown its capacity and willingness to use Petrobras as an instrument of national policy, leading to strategic pivots that prioritize national interests, pressure on domestic fuel pricing that can impact margins, and politically motivated leadership changes that create strategic instability. These actions create a layer of uncertainty that profoundly impacts long-term strategic planning and can lead to significant share price volatility.
So an investment in Petrobras isn't just about evaluating oil fields or balance sheets then. It's a much more complex calculation.
That's absolutely right. It's an assessment of the political and economic climate in Brazil, and an informed bet, really. It's a calculated position that the immense economic rent generated by its unique pre-salt assets will, over the long term, ultimately outweigh the inherent risks of its sovereign parentage.
A bet on the assets winning out.
Essentially, yes. The company's future performance will therefore be a continuous negotiation between its technical mastery in the deep ocean and the often shifting political currents in Brasilia. That tension is its defining characteristic.
What a journey. From the incredible engineering marvels deep beneath the ocean and the pre-salt to the intricate, often high-stakes dance with government policy, Petrobras truly is a company of compelling contradictions. It's a powerful testament to how global energy giants are shaped by so much more than just oil prices or geological good fortune.
Indeed. The story of Petrobras underscores that understanding a company's financial and operational strengths is only half the picture. The other half, especially for state-controlled entities, involves a deep dive into the political and regulatory landscape. It encourages us to look beyond the balance sheet and consider the broader dynamic forces at play that can shift a company's course.
So what stands out to you after this deep dive? Will Petrobras's world-class assets continue to defy political gravity? Or will national policy ultimately steer its course, perhaps away from maximizing shareholder value? It's a powerful question to consider for the foreseeable future.
And it's a reminder that truly informed decisions require not just facts, but a thoughtful assessment of the dynamic interplay between geology, technology, and political will. The enduring tension we've explored today will continue to define Petrobras for the foreseeable future, making it a perpetually fascinating subject to follow.
Thanks for joining us on this deep dive. Until next time, keep digging, keep learning, and stay curious.